I'm taking all my money out of the stock market. My clients never say that. What do I, as a wealth manager, feel about recent market declines and how that relates to taking withdrawals in the stock market during down sessions? Stay with me. So, as a financial advisor, I will say some of the biggest impact I have had in my entire career is talking people out of lousy decisions. And many of those lousy decisions come at periods of heightened emotions or periods of strong decline in the stock market. We're in a period of strong decline in the stock market over the past few days, if you've been paying attention to what's going on. And many of my clients' relationships span almost a decade now. Over time, I've trained my clients not to overreact to moments like this. If anything, to see potential opportunities, and that most importantly, selling during a serious decline in the stock market is usually never a good option. First things first, I want to say that this video is not financial advice. Please do not interpret anything I say in this video as financial advice. Please talk to your financial advisor. Please talk to your accountant. I've had many conversations over the past 3 business days with clients, and many of the clients know the routine that we're holding the position, but some clients do have questions. And when clients do have questions, there's a few key and very important things I tell them about holding the position during down markets. I tell people that we only take money during market highs. We do not take money when the market is falling or during market lows. I keep in constant contact with my clients, and I typically have anywhere from 2 to 10 calls with them per year. And one of the first questions I always ask them is, has anything changed in your financial situation since our last phone call? And are there any financial changes that you see coming up over the next 3 to 6 months? If we're in a good market period of good market performance, if they have a major expense coming up over the next 3 to 6 months, this could be an opportunity to go ahead, just carve that money out, park it in a money market, and so when they have a need for it, it's available. A good example is I have a lovely couple. They have 3 kids in college. So I know they have periodic expenses of tuition for each kid and occasionally some summer expenses for their kids. Well, during our December call, we had a conversation and I said, hey, the market is doing really well. Let's carve out some of that money that we know we're going to need in 2025 and sideline that in the money market so that when tuition comes, we know the money is there to pay it. So during the last few days in the market fluctuation, I had a brief conversation with a couple who were concerned about upcoming charges that they needed to take from the account. And I was like, hey, do you remember back in December when we carved out X thousand dollars and set it aside in the money market? And they were so relieved. It really took a lot of pressure off of their mentality that they didn't have to go into the stock market at a down moment and carve out some cash in order to pay these upcoming expenses. So one thing I do as a wealth manager, as a financial advisor, is think ahead for my clients. And I love those moments where I'm like, hey, don't worry about it. I know the market is not doing really well right now. We carved out this money in cash 6 months ago because I knew this expense was coming up for you. And the moment of relief in my client's voice and their demeanor means the world to me. So sometimes just thinking ahead 3, 6 months, 12 months, taking those expenses off the table when the market is high, tucking it away in the money market can be a good strategy to basically hedge in market volatility. Next, I consider myself an excellent wealth manager. I have every credential under the sun, and I've done this work for almost a decade. I still cannot tell you or anyone else when the market high is, and I cannot tell you or anyone else when the market low is. Even the best financial advisors, even the strongest investors, even the strongest stock pickers and market watchers cannot necessarily tell when the very high or very low of the market is. There's certain indicators that we pay attention to, but frequently those indicators are wrong or they're pointing to something else. So we do the best we can with the information that we have available, but basically staying the course is usually the correct answer. I will never call a client and say, hey, the market is at its absolute low, let's put money in. What I'll say is the market is extremely volatile right now. the market is in the lowest position it's been in a year or in 2 years. I can't say that the market will not go lower. There will be some volatility, but we're doing this for the long haul. You have some cash sitting on the sidelines. Do you want to invest? So it's giving the client all the appropriate caveats and warnings that I am not predicting the market bottom by any long shot. I'm just seeing a potential opportunity. Do you have the cash to invest? If anyone, any social media person, any financial expert, any financial advisor tells you that they can predict the very top or very bottom of the market, walk out of that meeting, because they are lying to you. Even the best people cannot predict the market high and the market. So I'm very proud to say over the decade, I've never really had clients take money out of the market during market downs. I've always managed to talk people off the ledge, even with things like COVID. When we had that big dip initially in 2020, I encourage people to keep their money in the market. I even had some clients put additional money in the market who saw fantastic returns in 2020. So I'm often able to talk people down off the ledge. But one question I always ask a person: if we take this money out, if we take all your money out of the stock market and put it in the money market, when do I put it back in? I have no idea when to put that money back in. I have seen some portfolios from non-clients. I was basically doing kind of a second pair of eyes on a client account. And this particular person had taken money out during a market dip, and the financial advisor who was in charge of this account sidelined the money. Well, that happened in 2022. The money was still sitting on the sidelines at the end of 2024. So yeah, they mitigated their losses in 2022, but they also missed out on the returns of 2023 and 2024 because that money remained stuck on the sideline because either the financial advisor just straight forgot about it, or he or she didn't know when to put that money back in. So money that is taken out of markets during moments of heat, during moments of decline, often remains on the sideline, and it misses that opportunity to regain what is lost when the market comes back. This one is an important thing that most people don't know, but it is critical to good investing. The best days in the market are often adjacent to the worst days in the market. I will say it again because it's a very important principle of investing. The best days in the market are often adjacent to the worst days in the market. So if you look over a 20-year span of time, 7 of the 10 best days in the market in that 20-year period of time occurred during a bear market. It occurred during a bear market. It didn't occur during a bull market. It didn't occur flat. It occurred in a bear market. And it often occurred adjacent to a really bad day in the market. So once again, if I take money out and sideline it, you may miss those lows, but you also miss those really, really solid highs. And portfolios are built around those really, really solid highs because the next fact is super important as well. If you invest over a 20-year period of time and you miss 10 of the best days in the market, if you invested in just the S&P 500, your performance will be cut in half by just missing 10 of the best days in the market. So once again, that money is sidelined. You're missing out on lows, but you're also missing out on the highs. And once you take those highs off the table and you take it out of the market and set it aside, you've basically kneecapped the portfolio performance. So once I tell people those few facts, they start to see, because I can't time the market because the best days are often adjacent to the worst days. And if you miss 10 of the best days in the market, you've basically halved your performance. Most people stop me right there and say, okay, let's keep it in. Some people have said, let's add in money. Before I place client money in the market, I always ask, what is the purpose of this money? And I want to make sure that they will not need this money for the next 3 to 5 years. Why is it 3 to 5 years? Because you need a minimum of 3 to 5 years to iron out any volatility or most volatility in the market. If the person comes back and says, hey, I think I need this money before 3 years, before 5 years, I'm going to buy a home, education, whatever, then maybe we look at other instruments for investing that money, including CDs, treasuries, money market. But Typically, if I'm investing in the stock market, I need at least a 3 to 5 year window in order to account for any volatility. Another thing that I will not do is invest people's personal savings. People need to have bare minimum 3 months living expenses and savings. I like to see more than 6 to 9 months usually, but we can start off with 3 months. But I'm not going to take people's personal savings and put it in the stock market. It's just too volatile, and there are moments like this where the market is off 20%, the S&P 500 is off 20% on the start of the year, and you never want someone to come back to you at this point and say, hey, I need some money, because now is really not the best opportunity to take money out of the market. So there you have it. I know the last few days have been scary for a lot of investors. Financial advisors are watching what's going on, and we are watching closely, but we understand these very important principles about when and how to take money out of the stock market. And we know for the most part, right now, when there is a decline in the market off the top of the year, it isn't exactly the best moment to go in and harvest money on almost anyone's account. So there you have it. Tell me what you think. Tell me what you like. And if you found this information useful, please like, share, and subscribe. Thank you.